an expectation that heading into next year defaults creep higher, not from a kind of gloom and doom perspective, not a toxic brew, as Tom would say, but definitely a closer to normalization of a long-term default rate. Now, one of the things that we're observing is there's not a really acute pocket of stress in a specific sector. It was energy for much of the past 8 years. It was telecom at one point. It was autos at another point. Now, instead, what we're seeing is these kind of specific pressure points where there are companies that just got their balance sheets highly leveraged. There was some sort of specific catalyst for that business that has been problematic. And the benefit of corporate America for the past few years is that all of those ultra low borrowing costs really buy a lot of time in a rising rate kind of challenged economic environment.
Winnie, one more quickly here, if we could. If you do IG, you're legendary at Wells Fargo over the years, IG, distressed, and all the rest of it. Do you make a 10-year full faith and credit call? Do you have a vision of where 10-year yield will be end of the year or out 12 months?
Yeah, so we do make estimates for the 10-year Treasury market, mostly because you have to have that to forecast where the credit market's going to go. We have a 3.4% year-end forecast on both the 5 and 10 years, so still very flat curves, as we did expect that the Fed is going to hike rates into that kind of 3.25%, 3.5% by the end of the year. Curves will stay very flat, and then we do have the Fed kind of staying on hold at that elevated level for an extended period of time to assess that lag effect between policy tightening and actual economic conditions.
Winnie, thank you. Winnie Caesar of Credit Sites, working through some complex issues. If you would like the weekly dose of JP Morgan optimism from Marko Kolanovic, here's the quote. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China should provide support for the global cycle in combination with still very low investor positioning, creates a positive environment. That's the latest from Kolanovic over at JP Morgan, Tom.
John, moments ago, Andrew Hollenhorst, of course, going decidedly the other way, says stop focusing on Powell's speech. It's a quote-unquote a hawkish month. They are adamant that a combination of what Powell will say and the mystery of the data to come should be aggregated together.
Still got payrolls to come before that next meeting.
Yeah.
Got August payrolls.
Too.
You've got inflation, I think, on September 13th. Lisa, so the road to September in that September meeting is still a long one.
I have a question for you.
Sure.
Are you trolling Marco or the Bears
why would
when
I
you
troll
put that
an
out?
equity strategist?
I mean, honestly, but this is a real question, not whether you're trolling him or the others, but he is so controversial.
I try and share a range of views on the sell side.
He is the consistent bull, and his view has not been very rangy in terms of its volatility. It's been very straight.
What's that diplomatic for? Rangy.
It's just been very solid in the bull camp, and he's been unwavering, which it's absolutely valid.
I'm not here to say that anyone's forecast will be wrong. I'm not here to say that anyone's forecast will be right. By definition, it's just a forecast.
He's a lightning rod, though.
I'm just here to work through different processes and different ways of thinking, different frameworks.
You're from Northwestern. They both sound very vulnerable this morning.
As I pick up that quote from Mr. Kolanovic, though, a stronger second half recovery in China. It's a controversial point.
They have to fly separately,
Inflation will resolve on its own. It's a controversial point.
All of it is.
It's some things to think about. Yeah. But if you were running a fund, wouldn't you want the most bearish and the most bullish person to come in and make their pitch? I'd want to hear from everyone.
Absolutely.
Stress test my position. Tell me why I'm wrong.
Fit your narrative to fit my faith.
Well, some confirmation bias. I think that's what I do. I just invite 10 people that agree with me, make me feel really smart.
That's why we're heading to Jackson Hole.
Probably end up losing money. Futures unchanged on the S&P, basically unchanged across the board here. Bit more euro weakness, 99.23.
We're in a fog.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. The US says that a nuclear deal with Iran is closer than before, but gaps still remain. A State Department spokesman says Iran has appeared to drop some of its, quote, non-starter demands. The Biden administration continues to review the EU's latest proposal to reviving the agreement, curbing Iran's nuclear program. Hedge funds are unleashing record bets that the Federal Reserve will stick to its hawkish script at Jackson Hole. The group has collectively placed a big short across futures for a key overnight rate that moves in line with the Fed's benchmark. That position will benefit if Fed Chair Jerome Powell effectively rules out a dovish pivot when he speaks at this week's symposium. And the price of U.S. natural gas rose above $10 per million BTUs for the first time since 2008. That extends a rally driven by concerns that global stockpiles aren't enough to meet winter demand. In the U.S., inventories are well below normal after summer heat boosted electricity demand. Meanwhile, production has grown only modestly. And Macy's has cut its profit outlook for the full year. The guidance missed the average analyst estimate. Still, the department store operator also posted second quarter earnings that were better than expected. Like its peers, Macy's is contending with shifting consumer preferences and shrinking budgets at a time of decades-high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean, if you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
That's the big call from Jan Hatzius of Goldman Sachs, the chief economist. Fantastic to catch up with him early this hour. With Tom Keene and Lisa Brabbits, I'm Jonathan Ferro. Your market shaping up as follows on the S&P, positive 1/10%. On the Nasdaq 100, up by 0.12. Yields basically unchanged, down almost a basis point on a 10-year, 3.0072. The trend over the last couple of weeks, though, higher at the front end. We'll pick up on that a little bit more a little bit later. 99.27 on euro dollar. Here we go. 4 days of weakness for the euro. Again, negative 0.16%. And the PMIs out of Europe this morning, not tremendous, not terrific, pretty ugly. Looking at manufacturing, and not just for the Eurozone, Tom, but for the UK as well.
Really historic moment. Steve Englander to join us in a moment. Right now on DXY, the blended large cap large country index. Kriti Gupta with a chart. Kriti, what do you have?
Yeah, Tom, we're looking at the DXY chart because of that, perhaps a little bit extra weighting towards the euro, and that really seems to be what's driving the entire market. As you see that dollar strength story, there are ripple effects into the stock market, into the commodity market. But my chart of the day goes back and looks at DXY going back to 2007. We're doing it on a log scale, and we're also looking at the slope of the last time you saw this kind of acceleration in the dollar. It's not just about the stronger dollars, but how quickly it's moving higher. And the last time you saw it was in 2014 and 2008. What's interesting here, Tom, is that those were the two time periods where you saw some significant commodity pressure, which brings me back to the Europe story. It really is all about the natural gas, the oil story that is now pressuring the euro, and then in turn driving the dollar higher and higher. So when we think about that dollar tending to weigh on commodities, well, it works the other way around too, Tom.
Kriti, thank you so much. The character of surveillance is simply we want to talk to the best people we can find. And we're honored when they come on short notice. He interrupts this morning with Standard Chartered Bank, their global head of G10 FX research. Stephen Englander joins us on your foreign exchange space. Steve, let me cut to the chase. What is the character, the nature of this historic bout of euro weakness?
Well, I agree that it's largely the natural gas story. I mean, you've seen them in recent days and recent weeks move pretty much together with the euro. There is a broader global story that the market is panicking about what Fed Chair Powell will say at Jackson Hole. And so, euro has two strikes against it, and which is why it went through parity so quickly.
Steve, has the ECB got a role to play here?
Like in a Greek tragedy, there's just not that much that they can do. There's destiny that's approaching. The economy is weak. When we talk about supply chain disruptions, we're not getting our exercise bikes. When they talk about it, they're not able to heat their homes. That's really weighing on sentiment in the euro, and the ECB doesn't have a tool to address it. The UK inflation numbers last week kind of, I think led people in the market to say, why is Europe different and what can ECB do about it? And the market, then when you see the way sterling is trading and euro is trading, the market's really punishing currencies that belong to central banks that have an inflation problem, but are really ambivalent about how they're going to approach it.
Steve, how do you think they should approach it? What's the optimal way to approach the situation the UK is in at the moment, the situation the ECB is in?
It's a very tough situation. I think that when so much is supply shocks, if you're a central bank, you want to try and smooth your response. When you don't know what the duration of the supply shock is going to be, you're really working in the dark. So I think they'll probably hike less than they should. Next year, if they come out of the winter and the energy situation is more clear, they'll probably hike faster, and that could actually give the euro some legs in 2023. But this year, I think it's moving very cautiously.
Stephen, you were talking about how supply chain disruptions have caused the people in the U.S. to worry about when they get their exercise equipment, but in Europe, worried about how to heat your homes. At what point does the U.S. start to experience something more similar to the European angst? And this goes to this idea of divergence, how far the U.S. economy can diverge from the European fate.
Well, insofar as it's related to a particular commodity, as natural gas, that divergence can extend for a long time. We might have to pay more for our energy, but we're going to have it. I think the European situation, if it's a very cold winter, and if the accommodation to increase supply doesn't occur, it could happen. It could be an extended divergence. It's not our baseline, but it certainly is a risk.
If there is an extended divergence, what does that mean for how disruptive dollar strength could become if it could escalate beyond where people are currently expecting?
Well, you're seeing different currencies react differently. Like, Aussie Kiwi last week, they've done poorly like everybody else, not so terribly. They don't have that kind of exposure. You have the yen that's done reasonably well. Again, they're benefiting from oil prices going down. The natural gas situation isn't as dire for them. I think it's horses for courses. And then you have a set of currencies like, Mexico, Brazil, some of the EM currencies where interest rates are high. So there's a buffer against Fed hawkishness. So I don't think, I think if the Fed is hawkish, it's going to be a broad dollar move. We think it's going to be limited. But, I think there are different, circles of currencies that will respond differently depending on their vulnerabilities and, in some cases, their strengths.
Steve, if you had to take a bet on the next 3% on euro dollar, higher or lower, weaker, stronger, where would you place it?
I think the risk is to the downside. But if you were asking me that question in January, I'd probably say to the upside.
Steve, awesome to catch up. Steve Englander of Standard Chartered. I think really putting it quite simply about the difficulty that Europe is in right now. Ed Yardeni Research published earlier this morning, and this is important. It's not just about the US economy holding on. It's about whether corporate profits will hold on in the face of what's happening in Europe. And he said this: a severe recession in Europe might not cause a recession in the US, but it certainly would depress the earnings of many US corporations. It would strengthen the US dollar further, which would also depress earnings of US companies with sales in Europe. Tom, that's the issue here, isn't it? Corporate profits versus what the economy will do.
It's at the margin in last quarter maybe, and I defer here to someone like Julian Emmanuel, where we were bailed out by strong nominal GDP, better revenues that mask that. But yeah, I agree, John. It can be a theme forward, no question.
Lisa, your thoughts on that?
Well, how much have we really gone through the secondary effects of a European recession and the divergence that causes not only dollar strength, but also weaker profits? To me, that I wonder how you game that out.
John, I'm absolutely dazzled, and you did so well with Liverpool, Man U, that I want to do Soccer Tuesday here with John, folks. I mean, the United Kingdom stops for Soccer Tuesday with John. And I want to go to Nottingham Tots like a week from now, a long ways away. And what I don't get
Sunday.
Is Nottingham has to play the Carabao Cup, whatever that is, and the Tots don't.
That's the league.
So they have to play an extra game in between.
I didn't know that, Tom.
That's unfair.
That's news to me. Thank you for sharing it. I'm reluctant to offer anything on football anymore, Tom, after my dire prediction.
That would never happen in the NFL.
Liverpool. It's going to last about a week, Bramo.
Really?
I'll keep it Jackson Hole focused into the weekend.
Soccer Tuesday.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
The job to bring inflation back down to the 2% goal is far from accomplished.
We do have inflation softening. We figured that the peak happened in the second quarter.
If we're being intellectually honest, we have to set up for some choppiness and volatility through the end of the year.
It's going to be a little bit choppy, but overall, we're going back into a growth market.
Markets are not perfect. They're not always rational, and they just sometimes need to be given the alarm bells.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, on the way to Jackson Hole. And John Farrow, the cliche is, it's August. This one's different.
It might be August, Tom, but it feels like winter in Europe already. Winter's arrived, never mind winter's coming. The PMI on manufacturing in the UK at 46, in the Eurozone at about 49. That's some really weak economic data already, Tom. And these central banks are hiking into it.
Open question. Markets on the move. Which data point matters to you, John?
Foreign exchange the last couple of days, TK. I think we're both on the same page on that front. Euro dollar, can we get used to a euro dollar?
No.
South of parity?
Nope.
At 99 and maybe at 97 if Matt Hornback of Morgan Stanley's correct, or 95 if Jordan Rochester over at Nomura is right. Tom, these are some big calls and they don't sound that big anymore. We're just around the corner.
Governor Bailey will travel to Jackson Hole. It'll be interesting, that photo shoot as they waltz out of the lodge across the vast acreage of the Bloomberg TV set to the split rail fence, John, where they look upon the elk and the buffalo and the bison.
Sound on it, Tom. We need some music.
What are Powell and Bailey going to talk about?
TK, what are they going to talk about?
What
They've
are
got
they
to talk
talking
about the fact that they need to get inflation under control. I think we've sort of lost vision of the numbers we're talking about. I lost an understanding of them. City's talking about 18% on inflation in the UK in January. I don't think we even know what that means, 18%, and the second-order effects around numbers like that, Tom. It's ridiculous. And when I talk about natural gas in Europe up more than 40% in a single month and taking out the spring peak, the chart's gone vertical in the last couple of weeks. I don't think we've really fully understood, Tom,
Lisa,
fully realised what that means.
What to me is fascinating here, Lisa, is we addressed with Jan Hatzius, this is a Jackson Hole of the haves, and they better focus on the have-nots crushed by 18% inflation.
Which is the reason why the message is going to be hawkish. That is the consensus right now, because the Fed cannot go out in good conscience and say that inflation where it is okay. What it is crushing, in your words, the lower income families, and it has been, Tom, pretty consistently. How high they can hold those rates, though, to me is the key question. Yeah. If they go to 3.5%, as Jan Hatzius was saying, and then they hold it there for a couple of years, what does that say about how much resilience is in the U.S. economy and what that does to completely rejigger financial markets as we have gotten to know them over the past few decades?
John, Jamie Dimon just emailed in and said, Tom, shut up and get to Phil. So we're going to do this quickly on the data up front. John, I'm going to look at the equity market, a rebound off the Dow, negative 600 points yesterday. Dow futures right now, John, up 46
Thanks
points.
for that, Tom. I'll let that one go. Futures up 0.2 on the S&P, on the Nasdaq up 1/3%. What did you do, Tom, yesterday? Posted a picture of James Milner shouting at Virgil van Dijk, and I was James Milner and you were Van Dijk, and I was screaming at you not to quote the Dow. Did you see
the Dow
me yesterday?
matters, John. The Dow is the emotion, the signpost
the Dow
for
matters.
America.
Okay, get to Phil. Get to Phil.
Let's do the data here. We'll do it quickly here. Oil, I'm going to save us with a rebound, $92 on West Texas Intermediate, Brent, $98 a barrel. Philip Camporiel is portfolio manager at JP Morgan Asset Management, but far more from Mary Airdros. He synthesizes the JP Morgan view. And at the bottom of the research note, Phil, it's real simple. You say America's the place to be. Yep. State the case for an enduring investment scene in America.
It's probably the more resilient economy to the G4 central bank hiking that we've been talking about for the past couple of minutes. Also, if you think about Friday and how much is at stake for Friday, I think Lisa's right. They're going to talk hawkishly. But as far as what we have to do, which is invest in the capital markets based on incoming data, I think the notion that markets have to move a material amount based on comments on Friday, we think is misplaced. So why is that? One, 10-year treasuries are back to 3%. That's one. Two, there is not imminent easing priced in anywhere. There's 100 basis points of tightening priced in between now and the end of this year, and 140 basis points of tightening priced between now and the first quarter of next year. Also, if you think about how difficult this year has been, it's been because there's been nowhere to hide. Fixed income has been a very tough place to manage downside risk. We think those days are over. Why? Because gas prices down 20%, Tom, from June. That's not the only thing. You have airfares down. You have owner's equivalent rent, which is staying firm. But the biggest drivers of inflation, we think, are headed in the right direction. And more importantly, the tips market is saying the same thing.
Okay, but John, you got to add to this, the Yankees are down as well. I mean, that's a bigger surprise
you brought that
than
up
oil.
early in the conversation. I thought we'd wait until the end, Tom. We'll let that go just briefly. Phil, if that's the case, where's the leadership come from in the equity market?
Yeah, so the leadership in the equity market, we think, comes from the growth parts of the market that were completely beat up this year with rates. And just to throw another Yankee reference in here, if Yogi Berra, the great Yogi Berra, it's not over till it's over, if he was talking about the fixed income markets, he'd be saying, just because the Fed's raising rates doesn't mean rates need to rise. And why is that? It's because fixed income is back to where it should be as a ballast in a portfolio. And if you're investing in the equity market, okay, I think there's more comfort now that fixed income could be that defense, which was very different from what we saw in the first 6 months of this year, John, when the Bloomberg aggregate index was down almost 12% at the worst point. John, the worst year ever for the ag was 1994. Okay, and we were down 2.9%. So I think the environment for investing looks so much more supportive than it did in the first 6 months of this year because of the sheer fundamental ability to manage risk, which was missing for most of this year.
So Phil, just to sort of underscore your point, are you saying that people who think that markets have gotten ahead of themselves and that financial conditions have loosened too much for the Fed's comfort have gotten way too cute about it, and that this is okay? that the real easing that we've seen in financial conditions through the rally in equities, through the rally in bonds, is just fine?
Yeah, I think so, Lisa. I mean, you had financial conditions as measured by the Goldman Financial Conditions Index, obviously off the tights. However, they should be off the tights if inflation peaked in June, which is our hypothesis. You can't overstate, Lisa, the effect of gas and commodity prices and how much pressure that takes off the Federal Reserve. Now,
so trading the peak is one thing. I just want to jump in. What do you think we're coming down to? Down from 9 to what?
Yeah, so we're at 8.5 now. By the end of next year, 2023, if the TIPS market is right, if our forecasts are right, you're between 2.5% and 3%. Heading in the right direction. Now, John, that's why there's 140 basis points of tightening still priced in. There's no victory declared here from the Federal Reserve. I just want to be clear. They will continue to tighten. We just don't think that the pressure of them becoming more and more hawkish for every meeting is the same as what it was in those really chaotic and frenetic moments in asset markets in June.
Phil, let's say that Jan Hatzius at Goldman Sachs is correct and that the Fed does not necessarily raise rates as high as some people have feared, but holds them at 3.5% for a prolonged period of time, possibly years. How does that change your narrative? How does that change your thesis about growth equities?
Yeah, that sounds like a really resilient economy, actually, Lisa, to us. If they're not imminently easing, by imminently I mean in the back half of 2023, that means that this race between inflation rolling over or growth rolling over is won by growth and the resiliency of the U.S. economy. And I think if you look back at the last cycle, Lisa, even if you have trend growth or a little bit below trend growth, like we saw in the last cycle, that's a really supportive environment for growth stocks. Even if you have a flat yield curve, that's a good environment for growth stocks. What you can have is a revisit or a retest of that anxiety from early in the summer when commodity prices were spiraling inflation out of control, which puts a ton of pressure on long duration equities or mega cap growth stocks. So Phil, it's still in a supportive environment.
Before we go, you can squeeze in the Yankees. Take a dig at the Red Sox if you want.
Not the Mets.
Yeah, and as Lisa's right, it's not the Mets, but the Red Sox are still in the rearview mirror, thank goodness.
That's a good thing. TK, anything to say on that? You're going to let that go?
My childhood was one of a rearview mirror. It's very important to understand.
Talk about
the Red
Dr.
Sox
Phil.
didn't win.
You said Lisa and I needed a therapist.
I mean, seriously, like my childhood.
Phil, thank you. Phil Camporelli of JP Morgan Asset Management. It's okay, Tom, to feel vulnerable.
I get emotional.
Share your feelings.
It's been a brutal year.
For Red Sox baseball.
Yeah, I feel Frank Malzone was our third baseman, and we had Ted. That's all we had.
What are they doing,
Dick
Tom?
Raditz.
Not good for the Red Sox, not good for Liverpool.
They're rebuilding.
Mr. Henry's having a tough year.
Yeah, they're rebuilding.
Okay.
I don't know.
All right, let's get to the market. We'll let that go, Tom. You take a beat. Futures up.
I'm unfocused.
By more than 1/10 of 1% on the S&P, on the Nasdaq up by 1/4 of 1%. The essence of what Phil's saying here, I guess, is that we go back to the old playbook.
Yeah.
Bramo. Rates will have to climb a little bit more, but ultimately they're looking for inflation to fade, and growth equities is where the leadership comes from. Dan Suzuki of Richard Bernstein on the show last week pushing back against that.
Well, also PIMCO pushing back against that, and Capital Group, a number of big fixed income investors who say that this inflation is different. It has a stickier feeling and it has a longer shelf life because of some of the structural changes with reshoring, with onshoring, with deglobalization, or perhaps a shifting globalization. How does that fit into his thesis of rates not having to rise even if the Fed raises rates, right? That we can go back to what we have once known.
What do you think the GDP price is that you need to pay to get inflation back down to 3%?
Well, this is the other thing, and a lot of people are saying that it's got to be pretty significant. That's the Bill Dudley point. That's the Larry Summers point, saying they have to be honest about the pain that the economy has to suffer. A lot of people disagree.
It's a toxic brew, Bramo. It's a toxic brew.
It's always a toxic brew,
It's a toxic
especially,
brew.
Toxic brew of Tang.
Pretty brutal out there. Doing okay, TK? It's all right.
I've lost focus. Phil's just crushed me here with the Red Sox.
It's coming up very shortly. Gas prices in America, should say gasoline prices
There you go.
in America,
Love it.
down for 70 straight days.
Amazing.
70 straight
John,
days.
can I opine?
Please, you've got 7 seconds.
Watch Sterling. I would watch Sterling like a hawk.
Thanks for sharing.
Thank you.
From New York.
I need an Narragansett.
This is Bloomberg.
Would somebody get me a Narragansett?
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. And sticking with that story, gasoline prices in the US have now fallen for 70 days in a row. That is the most in more than 7.5 years. According to the Auto Club AAA, pump prices are averaging $3.89 a gallon. That is after reaching what was a record high of around $5 in mid-June. There are signs that fears of a recession in Europe may be coming to pass. Economic activity in the Eurozone fell a second month. August drop was driven by manufacturing. Still, the post-lockdown rebound in services like tourism almost ground to a halt. Consumers have been hit by big jumps in both energy and food costs. The U.S. government reportedly has recovered more than 300 classified documents from Donald Trump since he left office. According to the New York Times, that includes papers returned in January, a second set given to the Justice Department in June, and the documents seized by the FBI at Mar-a-Lago. The Times says some of the documents came from the CIA and the National Security Agency. In Malaysia, former Premier Najib Razak will serve a 12-year prison sentence after losing his final appeal in a trial linked to the multi-billion-dollar 1MDB scandal. The court ruling will prevent Najib from running in elections that must be held by September 2023. Macy's has cut its profit outlook for the full year. The guidance missed the average analyst estimate. Still, the department store operator also posted second quarter earnings that were better than expected. Like its peers, Macy's is contending with shifting consumer preferences and shrinking budgets at a time of decades-high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
The markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
As the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
We're talking about households seeing a quintupling in their energy bills. A normal household paying, over £1,000 a month for electricity. It's a shock that is not going to be able to be absorbed.
This Jackson Hole promo is killing me. If I don't arrive at Jackson Hole Airport on Wednesday evening without that music playing, Tom, and if you're not there ready to pick me up on horseback to take me to the hotel, I'm going to be very disappointed.
Well, we've done the horseback thing before years ago. We did that. It was around 2007.
To transfer to the hotel.
McKee and I, we went up. McKee and I went up. This is coming out of the Jackson Hole Airport, and you go north up the Jackson Hole Valley. You get like a third of the way, halfway to Jellystone National Park, and Idaho's on the left, and it's all beautiful and that. But we did the horseback thing, and we were tired by the time we got there.
It didn't work out.
That's just a lot of work,
I just heard there's some budget cuts for this one, Tom. So maybe we do horseback to the hotel from the airport. Just something to think about.
Right now, our interview of the day, as we keep you informed, as we did with Stephen Englander of Standard Charter on the currency market, to drift away from the real struggles and agony of Europe and hydrocarbons. Stephen Shork joins us, principal at the Short Group here, on what has been unspoken. Natural gas is a moonshot in America as well. Steve Shork, there is the spread out into March and April called the Widowmaker spread, which is the guesstimate of how low inventories will be. How low will inventories be when the Widowmaker spread matters?
Yeah, absolutely. This spread is the difference between gas delivered for the final contract of this winter, approaching winter, and the first contract of next summer's refill season. And that spread right now in the month of August is trading as if we are in the dead of winter. It is a clear signal that the market is betting that we are going to be short gas throughout this entire winter, which is a problem because at the current rate, we're entering winter with stocks at about 200 BCF below normal, well below the EIA estimate, which is 3.43 TCF, and well below the 5-year average. So going into the winter, stocks very low. The back end of the spreads are telling us that stocks are going to remain low, which is going to be a problem for our winter heating bills because not only has natural gas prices tripled over the last year, but two oil stocks, heating oil stocks here in the Northeast, in New York Harbor, are 20.5% below normal, 3 million barrels below normal, which is going to be a problem for people who heat their homes with oil, primarily in the Northeast. So as we look ahead, the spreads are telling us the market is short product, winter product, and hence higher bills this winter.
Are we going to run out of jet fuel? I mean, what's the use of fuel in the Northeast? I know it's a heating oil region and all that, but are our viewers and listeners supposed to say, OMG, it's going to be like Europe?
Not quite like Europe, but we're certainly setting up the dominoes to be like Europe in a couple of years. Of course, that translates into natural gas. And right now, as we know, Europe is very short natural gas, primarily because they put all of their eggs into the basket of a tyrant. And that tyrant now is keeping supply short. That supply gap is being filled in part by U.S. LNG. But back at the start of the summer, we had a export facility that went down, which accounts for 20% of U.S. exports of natural gas, which primarily were going to Europe. Now that facility is going to come back online partially in October. So that's going to be an even further strain on U.S. inventories going ahead, because the ARB, right now, European gas prices yesterday traded the equivalent, check this out, the equivalent of $470 barrel crude oil. So if you can export natural gas, you are exporting everything you have right now.
Let's get Lisa in here.
Well, but Stephen, that's exactly where I was going to go, because this was actually when the Freeport facility went down, that actually lowered prices in the U.S. And when it goes back up, people are expecting it to cause prices to go up because of what's going over to Europe. Are we pricing in a full seizure or a full closure in terms of the Nord Stream 1 pipeline and the liquefied natural gas flowing from Russia to Europe?
Yeah, to your point, yes, it's an excellent point, and that is, I do believe, part of what is happening in that back end, that March-April spread. I want to put a caveat out there, though. That March-April spread is probably the most liquid spread in any commodity market, highly traded, highly speculated on. This was the spread that blew up a $9 billion hedge fund, Amaranth, back in 2006 because they were playing games with it. Traditionally, mathematically, statistically, what you tend to see is the March contract tends to lower, get weaker relative to the April contract as we go through winter. So we should keep an eye on that. But right now, the front end of the curve is trading as if we are in the dead of winter, and the back end of the curve, because of your points with regard to the lack of supply, both here in the United States and the drain that we'll see because of Europe, is keeping that back end of the spread very high. And which means we're going to see high winter heating bills and likely high next summer air conditioning bills, because natural gas is such an important feedstock into electricity generation.
Stephen, just quickly, I saw the headline from OPEC Plus yesterday from the Saudis. I had no idea what they were talking about. Can you just digest that one for me and translate it? What were they saying?
Absolutely. So what the Saudis were saying essentially is there's a major disconnect in between the physical market, the actual market that they trade, and the futures market, the paper market, which again is very high in speculation. So the futures market has been very low relative to what the Saudis are seeing in the physical market. So they came out yesterday with a pretty hawkish view, which sent oil prices screaming higher, that they might actually have to cut production, which really caught the market off guard. But, you know, interestingly enough, that headline came out about 2 hours after all the headlines were breaking, that the West is about to make a deal with the Iranians on very favorable terms to the Iranians, which, again, the Saudis are not very happy about. So you tend to see a bullish or a hawkish headline coming out of Saudi every time you hear a dovish headline coming out of Iran. So it is a game of push and pull on the geopolitical front.
Stephen, just quickly, I've got 30 seconds, but it's so important. I never know what to do with those Iran headlines. What do they actually mean? How close are we to a deal? I feel like we've been doing this now for months.
Yeah, we have been doing it for months, and my concern was that the administration, because they're in dire straits with regard to the midterm elections and high energy prices, they were going to strike a deal with Iran. I'm still skeptical. You know, maybe it's a little bit of hope that we don't reach a favorable deal, because given where Iran's geopolitical intentions are, not a good step to keep on putting money into their state coffers right now. Yeah. So hope, but probably we'll see a deal.
Stephen Shaw, thank you, of the Shaw Group. I find all of this very, very difficult to understand, Tom, and piece together.
We got this out of the archives, the surveillance archives. This is a great image of Kathleen Hayes and Michael McKee moving from the airport, and they're up past Moose, Wyoming here on Beaver Creek on their way to Jackson Hole.
Were you driving?
Kathleen, she's driving.
Oh, she's driving. You weren't.
Yeah, she elbowed Mike and said, I'm doing it. No, I wasn't there. I'm afraid.
Do they have surround sound so we can play that music?
Very soothing. Music goes with it.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a gray zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
Live from New York, good morning to you. Futures positive, 0.1% on the S&P. On the Nasdaq 100 up, let's call it 0.2%. Yields higher by 3 basis points, 3.0, let's call it 3.05% on a 10-year. And if you look at foreign exchange, the dollar stronger again against the euro. Euro weaker, fourth straight session of this. 99.20 on euro dollar, Tom.
John, we need to color that and say there is a weight to this. Like this bid happens, you get a little pop and you come right back.
And we saw that yesterday, Tom. We're down a few tenths of 1% on that currency pair. And then I think by the end of the day, we had a move of almost 1 full percentage point.
For those keeping score at home, I would also focus on dollar yen 137.50 for what it's done, which is it hasn't moved. If yen was to give way 138, boy, would that change the dynamics a lot. Exceptionally strong set of conversations today. Jan Hatzius of Goldman Sachs joining us, and we continue strong now with Stephen Risciuto. To say he's chief U.S. economist at Mizuho Securities barely describes their desk. With Dominic Constant, Stephen Risciuto folds in a massive macro view, including a calculus of GDP in America. Steve Risciuto, when you talk to Dominic and the two of you get together, are we in recession?
The NBER will not classify it a recession. To me, 2 quarters of consecutive negative GDP reports, implies you're in a recession. The problem for people is going to be that this is going to be a very shallow, very long recession. It's not going to be the typical recessionary environment that we've seen since 1990, which were credit cycles, nor is it going to be the typical inflation cycle that we'd experienced in the post-war period up to the 1990s. It's a very, very different cycle. It's a long, shallow cycle.
Right. Well, within that, and this has been the theme for the day, Steve Risciuto, if you have a long, shallow cycle, does that mean the real message from Powell at Jackson Hole will be a more sustained view of interest rate strategy and not the foolishness of the when do rates come down?
Oh, that's exactly been our call all along in here, that we were basically looking at a dynamic of a pause, not a pivot. The question that we're still debating, is it 4% or is it something north of 4%? I think we have to get to at least 4%. And last time I was on, we were talking about it. We were pricing 3.5. Now we're pricing something in between the 3.5 and the 4. I think we'll get to the 4, and hopefully that will be the end, but it may not be the end of this scenario.
This is the raise and hold debate, Steve. We caught up with Jan Hatches of Goldman. Take a listen to what he had to say.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean,
really?
If you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
Raise to what and hold for how long? Raise to 3.5% and hold for a couple of years, Steve. What do you think of that?
Well, I think we're going to keep on moving higher than that. I don't think 3.5 is the top, and nor do I think necessarily we're going to hold it for several years. I think there's clearly an argument to be made that we're going to hold it through 2023, but where we go in 2024 is a very, very different animal altogether, because you have to look at what's happening in the currency, and you have to look at what's happening with supply chain related issues, and then you have to look at the demographics in the labor market environment, and it's this tug of war that we're going to see from a stronger currency, supply chains easing up, versus the wage-related pressures that are being dominated by the demographic issues, in particular, the reduction in the number of workers from the millennials to the Generation Z, which is now entering the labor force. So we might wind up in an environment where the Federal Reserve has to sustain higher rates on a longer basis than we've seen in here for quite some time. But again, what the starting point is still an open book.
What's the advantage, Stephen, for the Fed raising rates beyond 3.5%? What's the end target and why, especially if they plan to then take them down to something lower over a longer term?
Well, again, do they plan to take it down to something lower over the longer term? The real question is, how does this labor market dynamic play out? You can make a very, very strong demographic argument that the labor market stays tight throughout the entire period in here, and therefore you are in a sustained higher level of interest rates going forward. The question always is going to be, what level of rates will that be sustained at? But a quick return back to the near zero interest rate environment that we've been anticipating or that people have been somewhat anticipating, is going to require some kind of credit event to unfold in the economy. And when you look at the underlying credit quality of the economy in general, there are some pockets where we are concerned, but in aggregate, the balance sheets are still very, very healthy.
So what is your top Fed rate that you're kind of penciling in here? How has that evolved over the past few months?
Well, it's evolved a lot, over the entire period of 2022. But I do think 4% is the near-term target. And I think once we get to 4%, we will pause for a time. Whether or not that's a pause to go higher or a pause to continue to hold that level on an ongoing basis, that's where my thought process is.
Steve, inside baseball, if we've got China with subpar China growth, the dynamic of exports minus imports, how does that change, and what does that mean for Chairman Powell?
Well, again, that comes right back to the currency story, because it's the supply chain dynamic. You have a slower global GDP environment. Clearly, what's happening in Europe is creating a wider GDP output gap globally. You have a strong currency, which will allow us to import those products on a more competitive basis, which will wind up dampening domestic inflationary pressures. And then you wind up with, where does the services dominate over the goods portion of the equation? And I think this is the reason why inflation is going to come down. Whether it'll get as quickly as the Fed would like to see back to their target or not, I think it'll get there. I think it'll get there probably in 2024. I don't think it'll get there in 2023.
Steve, my first exercise this morning was to look at the Bloomberg Financial Conditions Index for the United States and for Europe, and to note back over 30 years that this is the first time they've diverged so sharply. Now, obviously, there's a war in Ukraine, which is dealt to this. What does Bailey say to Powell, or Powell say to Bailey, on this immense transatlantic divide?
Well, I mean, I think, the situation is the reverse of what we experienced in the 1970s, where the Federal Reserve Chairman at the time, Paul Volcker, came back from an IMF meeting and was forced to change monetary policy abruptly and caused, one of the worst macro recessions, inflation recessions we've seen in our history. And I think all of the problems on the currency side of the equation are really European problems. And Europe has to address its issues. We can't fix its problem for them. And that's pretty much the same message that, Paul Volcker got in reverse when he came back from the IMF meeting in 1979, which was basically, you have a problem with your currency. That's why your currency is going down. You have to fix your problem. And I think Powell has to push it right back on them. You've got a problem. You have to fix it. We can't fix it for you.
And this is the different kind of FX war, Lisa, we've been talking about through much of this year. This is a big problem for Europe. And it's kind of strange because 10 years ago, this is exactly what they were trying to engineer, a weaker euro. They couldn't get one. They couldn't buy one. And now they've got one, a dramatically weaker euro at a time that they arguably don't want one.
Absolutely, importing inflation. How much, though, is this also a problem for the U.S.? And we haven't really talked about that, John, but this was something that you had discussed earlier in terms of the Ed Yardeni note, which is how much of a pressure will this be on the balance sheets of companies that sell into Europe that have to deal with the headwinds from a stronger dollar? I don't think people have gained that out sufficiently.
Well, the multinationals are going to have a problem, aren't they? But that's a corporate profit story, what it means for the broader economy. The other issue that we've got here as well, Steve, Tom asked an important question. What does Governor Bailey say to Chairman Powell? Governor Bailey is seeing economic weakness right now in a more pronounced way than Chairman Powell is. And Governor Bailey hasn't seen the year-over-year peak in inflation. You've got him forecasting something close to 13%. You've got Citi saying it might be 18%. Steve, isn't that the bigger difference right now? The transatlantic divide is that the US may be able to take some very, very small amount of comfort from this idea. We might have seen peak year-over-year inflation. For Europe and the UK, is it still in their future?
Well, again, this comes down to the fact that you remember the way we broke the back of inflation here was not just a monetary policy scenario. The supply side revolution failed in terms of many things, but by breaking the back of labor through firing air traffic controllers, we did a lot in terms of changing the labor market dynamic, which was our problem back then. So again, you have to push the blame back just not on central bankers. Central bankers have to push blame back on politicians and say, you have to correct what you've done from a policy standpoint that has put us into this position, and it is your responsibility now to take the steps that are necessary. You can't expect central banks to solve all of the world's problems.
Steve Rasciuto of Mizuho. Steve, thank you, sir. Looking ahead to an important meeting later this week in Jackson Hole, Wyoming. Governor Bailey will be there, Tom, Chairman Powell. Who's there for the ECB, Lisa?
Schnabel.
Schnabel.
Yeah.
Looking forward to that as well. I think we're going to hear from all three at some point, Tom.
It's going to be, I don't know what to make of it, John. I just think if the market is here, where is sterling? Where is euro in 24 hours? Where are they in 48 hours? You're going to tell me that they're going to have a normal dialogue with a 116 pound? I don't think so.
And a 99 euro dollar.
98,
We came close this morning, sure.
I don't want to oversell it. I don't want to hype it. I mean, just,
I don't think you are.
You and Lisa on a wagon train alone is enough.
Okay, you're overhyping
to hype it. But it's John, you get north of Moose, Wyoming, and the bugs get less.
Okay.
You get into some of the glade by the southern part of the lake.
I don't know.
Like it's the black flies.
The bottom line here is we're teeing ourselves up for some market moves in 4 days. It makes his speech possibly more interesting than we ever thought.
The FX channel is tremendously important because, as Lisa said, you're importing inflation. Arguably, you would want a stronger currency. Europe and the Bank of England and the ECB, they can't buy one right now. And the complication, the added complication, it gets really complex.
Policy, it has to do with the ramifications of a natural gas price that has surged more than 100% in the past few months.
This was fun. We'll be talking about horseback riding, counting you down to the opening bell. We won't. We won't. Emily Rowland of John Hancock Investment will be joining us, George Bory of Allspring Global Investments, and David Leibovitz of JP Morgan Asset Management to guide you through to the opening bell.
Can you do this, John, like where you're lassoing, you're swinging the lasso?
I can't do that, Tom. Can you do that?
I can't do that, but then I can't hula hoop like you do.
I'm a good hula hoop.
I'm not.
Why would I be a good lassoer?
I don't know. From some of the stories I've heard, John.
A lassoer. Is that no? Not a word? Not a word.
I don't know.
You know, when I was a kid, all I wanted to do was dress as a cowboy.
It's like petrol.
That makes so much sense.
4 years old and wanted to go to my auntie's wedding in Italy dressed as a cowboy. It meant the world to me.
Pictures.
John, you'll have the opportunity to dress as a cowboy on Thursday.
Can I dress as a cowboy Thursday?
Yeah.
Without offending people?
Chaps, spurs.
Relive your childhood dream, John.
I think that the people of Wyoming are less prone to being offended by things like that. I think they've got a high tolerance level.
The rest of the world, not so much.
They'd welcome it, maybe. Future's unchanged. They didn't welcome it in Puglia, in the south of Italy. It just wasn't allowed. What are you doing down here?
Is this on-air therapy?
Well, I think we've got, we were going to first word news, but given the 60 seconds left on the clock, I'm not going to do that to Michael Barr and Riddick Gupta, Tom. Let's go a little bit longer. We've got about 50 seconds if you want to fill it. Got things to say?
I got pivot,
What's your pivot?
I got pivot. I'm sorry. The gloom is out there, and I'm listening to the bulls, trying to discern what the bulls are saying.
Well, I've given you the bullish view from Marko Kolanovic over at JP Morgan. He thinks
that's one view, but
this inflation
Julian,
story will just
Jonathan,
ease on its own, and that China will pick up and things will get better.
I think there's a set of maybe we could use this music.
What I would like tomorrow is the music used on the promo to go out to the breaks with.
I like that the music, they just keep playing it, hoping that we'll stop. We're not stopping.
Look, I voted, John,
hit my mark.
John, for the music for the Jackson Hole, I voted for Nickelback. I got nowhere. No. Maybe Flying Burrito Brothers?
Okay. From New York City, this is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
We had the choice of backing a brilliant card designer by the name of Henrik Fisker or an ambitious, slightly crazy entrepreneur by the name of Elon Musk at Tesla. Well, we made the wrong decision, but Tesla did very, very well, and so did electric vehicles.
One of the most interesting and one of my most favorite people on the planet. His name is John Doerr. He's chairman of Kleiner Perkins, the author of Speed and Scale. It is a conversation with David Rubenstein. I really can't say enough about that. Look for that tonight at 9 p.m. Lisa Bramwitz and Tom Keene with Mr. Rubenstein now. On a guy, David, John Doerr, Intel was 3,000 employees when he joined. It's now well over 100,000, even with the challenges that they have. And what I find so interesting, David Rubenstein, is this is a guy that's lived the boom of the Young Turks of Silicon Valley, and now they have to make a generational shift. What did he say about the challenges of a generational shift in our tech wonders?
Well, he did incredible things in the internet era, and he was an early backer of Google and an early backer of Amazon. And as a result of that, he's been able to make recently the largest gift in Stanford's history, $1.1 billion to create a sustainability school. And that is the result of his very smart investment decisions during the internet era. Now he's focused on climate change, and that's his sole investment focus as well. He's giving a lot of money philanthropically there, but also he's now making investments in all kinds of companies that are likely to have some impact on climate change.
What is he saying about the people that literally he birthed? I'm absolutely fascinated. The shift at Amazon, the shifts at Google, and on and on. How did he address this generational challenge of people who think they're different than Colgate-Palmolive or John Deere?
Well, clearly people in Silicon Valley who get money from firms like Kleiner Perkins, John Doerr's firm, obviously have large egos and think that they're going to change the world. In some cases they do, in some cases they don't. He's unusual in that he really spends an enormous amount of time trying to figure out how he can help these companies. He doesn't just give them money, but he's willing to work around the clock to make sure these companies succeed. And that's what he did with Amazon and Google and had a big impact on them. Now he's doing the same in the climate change era. And I would say that he was motivated to do this in part because when his daughter, one of his two daughters, watched Inconvenient Truth about the climate change problem, his daughter said to him, your generation screwed up this country and screwed up the world. What are you going to do about fixing it? And so it motivated him to actually do something about it. And now that's what he's really dedicating the rest of his life to do.
Over the past year, we've seen a little bit of a reversal in some of the efforts toward the greenification of the energy supply. We've seen a reversion back to coal, fossil fuels in the wake of some of the shortages and the Russian invasion of Ukraine. Did he talk at all about the willingness to invest even more at a time when there is more of a question about the importance of fossil fuels and not discounting them?
Well, his view is we don't really have a choice. Right now, the planet is not going to be able to be survivable if we don't make changes in the way we generate energy for people on the face of the earth. So he doesn't really think there's a choice. He does recognize that because of the war in Ukraine, many people have probably said, well, climate change is something we can worry about in the future, and we don't have to worry about conversion to renewable right now. But that's not his view. He thinks it's more urgent than ever, and he has a very elaborate plan how we can convert our efforts now in using energy from carbon to renewable sources, and he's quite passionate about it, and that comes through in the interview.
The passion versus the profits, and that has been something that a lot of people have been trying to discern, especially with the ESG focus that hasn't always delivered in terms of the returns. How does he sort of parse this out? I understand the ideological drive that he has towards some of these causes, but where does he look for the returns to come?
Well, remember, he's looking to back small companies that are going to grow into the Amazons and Googles in the climate change area. So when he backs a company, it's going to take 4, 5, 6 years or so before it might be apparent whether it's going to work or not. But he thinks we really don't have a choice because if we keep doing what we're doing, ultimately the planet won't be survivable. And so he's very passionate about it, more passionate than he probably was about the internet.
David Rubenstein, in the day-to-day grind of David Rubenstein over the years, why doesn't Europe have a John Doerr? Why doesn't Asia have a John Doerr? And of course, the backdrop here is a debacle of SoftBank. But why is it just about America that we have a John Doerr?
Well, clearly America is more entrepreneurial, I think, than Asia and more entrepreneurial than Europe. We have a much more bigger venture capital world than either Europe or Asia. And I think John Doerr is the personification of what our venture capital world can do. It has a very talented people who've been trained as engineers, as John Doerr was, but now are committed to doing other things. And, you know, John Doerr is probably the best known of the venture capitalists in the United States right now because of his success over the years. But there are many other people like him. And you're correct in pointing out there aren't similar people, or not very many of them, in Europe or in China.
David, thank you so much. Congratulations on this important interview tonight,
Thank
9
you.
p.m. David Rubenstein with Mr. Doerr of Kleiner Perkins. Really looking forward to that. Moments ago, Steve Rasciuto's colleague Dominic Constam has published at Mizuho. I'm going to call it a pre-Jackson Hole note. And Lisa, Dominic Constam doesn't mince words, rather, within the dynamics he's always looking at. Is this a Fed that will further front load, or is this a Fed that will find some form of steady state? That's the debate.
And it's hard to know. He talked about the less euphoria for now as people await what's going to happen at Jackson Hole. You love the Fed gaming out system, which we've been trying to go back and forth on. But the longer term run rate is the important thing. And that's why he's looking at break-even rates. Tom, how much are people looking at a Fed that can get much beyond 3.5% still to that 4% level of his colleague Steve Rasciuto versus that they have to pivot, right? I mean, at what point do we see that terminal rate being unsustainable versus something that's needed for the inflation that we have?
At least I haven't asked this question, and Tarunas, it's late Tuesday here. What is credit saying about this debacle of the last 2 days? What is IG saying?
Well, I know that in high yield, they've had a really miserable couple of days, and you've seen a pretty significant sell-off in high yield. In investment grade, it's held in a little bit more because there has been this pivot to higher quality, but there is a concern, and this is what we were talking with Winnie Caesar about. Perhaps there's not going to be the default cycle of yore. However, if you get benchmark rates that present an alternative, then what is the argument to go into leveraged companies at a time where Dominic Constam and frankly Steve Rasciuto were saying we could see a prolonged recession?
No.
What's the argument then for over-leveraged companies that have to grow into their capital structure? It becomes a lot more difficult to see.
Major shout out here as we get ready to go to Wyoming. Qantas last night, we had a phone call as we were down Dow 600 points, and the team blew up the show today to give you the best in conversation with Stephen Englander of Standard Charter and Dr. Hatzius at Goldman Sachs, among others. Let me do a data check here to stagger into the 9 o'clock hour. We had green on the screen, a nice elevation. Now red, futures -2, Dow futures -24. The VIX gives me nothing, 23.82. 210 spread, very importantly, disinverts 27 basis points, well worth watching. The story in foreign exchange, the frontline DXY index 107, 108, stronger dollar, 109 right now. Euro a 0.9926. Sterling, Pharaoh's broke. Stay with us. This is Bloomberg. Good morning.
When I started, I had no idea it was going to turn into this. It's a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
The top names at the Fed are on Bloomberg.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. 50, 75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent.
Nobody covers the Fed like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
Live from New York City this morning. Good morning, good morning. A bit of calm after that mini bearish storm. Equity futures unchanged. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. Winter is coming.
You're going to see more headwinds.
Europe is going to really face some very strong headwinds.
The pain will be concentrated around the winter months.
The data aren't great.
Conflicting data.
Headline data, was disappointing.
I worry that there is bad news ahead.
The Eurozone and the Euro is beset with a very ugly menu of problems.
Massive increases in headline inflation.
Surging energy prices.
Gasoline prices, supply chain woes.
High gas prices.
Recession
in the U.S.
A mess.
There's further downside risk.
The winter is coming.
Joining us now to discuss all springs, George Bory, Emily Rowland of John Hancock Investments. Emily, first to you. Some people might argue winter's already arrived in Europe. The S&P 500 down 3.4% in 2 days. The Nasdaq down about 4.5% in 2 days. Do you think reality is starting to bite again?
I think it is, and this big backup in bond yields that we've seen in the U.S. really is a result of these elevated inflationary readings in Europe. In the U.K., over 10% CPI. You're seeing German PPI at the highest level in 70 years, a 37% increase there, causing this backup in sovereign bond yields, which has trickled over here to the U.S. with the 10-year Treasury now over 10%, and that's causing some challenges here to markets. Clearly, Europe is likely in a recession already, if not going there very shortly. And we are seeing a really kind of diverging path of economic growth here, with the U.S. still holding up stronger than the rest of the world, but clearly some challenges here as far as the global growth picture goes.
We spent the last couple of months wondering whether we've seen the low on the S&P 500 for the year back in the middle of June. We've got to work out whether we've seen the high on a 2-year yield. We're up about a basis point today on 2s, on 10s up about 5 to north of 3%. On a 2-year, 332. George, your thoughts on this? 332, the highs of the year on June 14th of 345 intraday. Can we get back to those kind of levels, do you think?
I think we can, Jonathan, but it's going to take some stronger data. You know, as we just mentioned, you know, the data is mixed. It's very mixed, both internationally and here domestically. Obviously, the world is focused on inflation everywhere. Inflation is still high. That keeps the Fed in play. And that will continue to put pressure on the front end of the curve. But that pressure is getting increasingly focused on the very front end of the curve. And as we move out 2 years and beyond, what you're finding is a little bit more of a range pattern for the yield curve. And so when we look at the curve, you know, 2s, 5s, 10s, all the way out to 30, this kind of, you know, sort of 3% plus or minus around 25 basis points seems like a range that we're going to hold as we go into September and possibly even into the end of the year.
Into the end of the year, George? You think that long? Why?
Well, because I think the data, you know, it's a very mixed backdrop. We're seeing pockets of weakness, but not a collapse. You know, there's plenty of pressures. There's headwinds everywhere. We're looking for new headwinds. We don't see a lot of new headwinds. It's the old ones remaining more and more persistent. The one area of weakness that we see, housing. Housing in the U.S., very interest rate sensitive. You are seeing the housing data come down, coming well off the boil from a very, very strong market. That is one bit of new news. Everything else as it relates to inflation, as it relates to growth, it's sort of a retread of the same trend that has been persistent all year long. That means a consolidating market as we kind of go into the end of the year and the next new trajectory sort of ultimately emerges.
Emily, something Phil Camporelli said of JP Morgan this morning has stuck with me. He said, just because the Federal Reserve is raising interest rates doesn't mean rates have to go higher. Do you agree with that?
We actually do, John. You know, we think that because the Fed has made such aggressive use of forward guidance here, we've already seen a lot of the moves in bonds actually priced into the markets already. And what we actually look at is the leading economic indicators. A lot of, you know, George made a great point that the data is very mixed right now, but a lot of what the Fed is looking at and what markets are looking at are lagging economic data. And John, friends just don't let friends use lagging economic data in making investment decisions. We want to look at where the leading data is going, and the Conference Board's leading economic indicators came in at 0.0% as of July. And there are still a number of elements in there that we think are going to see further weakness before we can start to declare a bottom. Now, typically when the leading economic indicators are falling, so are treasury yields, because investors are looking for safer assets as this decelerating growth environment continues to play out. So we actually think that we'll see some choppiness in yields here, again, based on this mixed economic data. But ultimately, as we enter a recession, we actually see yields moving lower. That's typically what happens, and we do think that this time will be the same.
I have to say, you're on the same page as Max Kettner over at HSBC. We talked about his research yesterday. I'll share it with you again just in case you missed it. Our leading cyclical indicators all point to more broad-based weakness in the second half, with warning signs flashing for the housing market, for the consumer, and also increasingly for labour markets too. Goes on to say we'd likely add to DM sovereigns before sounding the all clear on risk assets. There's another way of looking at this too. Comes from Marko Kolanovic over at JP Morgan. He wrote this yesterday. Inflation will resolve on its own as distortions fade and likely drive a Fed pivot. A stronger second half recovery in China should provide support for the global cycle. In combination with still very low investor positioning, it creates a positive environment for risk assets. George, your thoughts on that? Just those 3 points that the team over at JP Morgan are making, that inflation can resolve on its own, it develops into a Fed pivot, you get a stronger second half recovery in China to support the global cycle, you combine that with low investor positioning, and you've got a positive environment for risk assets. Do you agree?
Well, I think it's a very sophisticated view on markets, and we would really simplify that, and we'd say really since the middle of this year, the world has become a more bond-friendly place. Inflation is still high, but growth is slowing, and central banks are moving aggressively to bring down inflation. That equals a more favorable environment for bond investors. And so we think, as we just heard, that there are some relatively attractive opportunities in the bond market. It's not quite the time to sort of go super long duration, but taking sort of duration positions make a lot of sense. Selectively in credit, which is also materially repriced, taking, again, selective opportunities. And so the prospect for positive total returns in fixed income, we already saw a very good month in July, seeing also a reasonable month in August. We're likely to continue to see sort of ongoing improvements in the bond market as that data, as the economic slowdown emerges. And that to us is pretty constructive. It's a very sophisticated message that we just heard from some of our colleagues and competitors, but I think it can really be simplified down to, the world is just simply a more bond-friendly place right now.
I sense you're being very diplomatic there, George. Maybe some strategists getting too cute about the future. I'll try and keep things simple, Emily. If you're expecting a lower growth profile that supports lower yields, particularly at the long end, is that complemented by a softer inflation story too? And where does that come from?
Yeah, absolutely. And by the way, just to simplify things even further, we've been going with the hashtag bonds and chill, which basically means move up the capital structure, get paid income here. You're getting 3 to 5% in high quality bonds, including investment grade corporate bonds, and wait for this mini cycle that we've been experiencing since 2020 to continue to play out until we get into the recession. We do see, John, inflationary fears receding here. We do believe that inflation likely peaked in the first quarter. It is going to take a long time, though, for it to return to the Fed's target of closer to 2%. But we do ultimately see inflationary fears here turning to growth fears. We have to remember that the Fed is doing their job here to raise rates aggressively, to dampen inflation, and ultimately that's going to turn into demand destruction. We're already seeing signs of that. So we want to be really mindful about that in terms of positioning across portfolios, not only embracing bonds, but also looking for higher quality, more defensive assets in the U.S.
We've been asking repeatedly, raise to what and hold for how long? That's going to be a big part of the conversation with Chairman Powell in Jackson Hole, Wyoming, when we have that annual Fed get-together later this week. Jan Hatzius of Goldman weighed in on this. Take a listen.
Where I would disagree more with market pricing is the pricing for significant rate cuts. I think it could be a couple of years. I mean, really? If you get to the mid threes or maybe even a little bit higher, and then you stay there, because I think while inflation will look a lot better a year from now, I think it'll still be significantly above the target.
George, what do you make of that? Raise to what, hold for how long? He's talking about 3.5% and maybe for 2 years.
I mean, yield staying, sort of having Fed funds up around 3.5% for an extended period of time is not atypical. It's very similar to what we saw, sort of prior to the credit crisis back in 2008. And so it seems like we're going back to sort of the old normal, not a new normal, and sort of an old normal where, hopefully inflation, sort of coming back down to sort of more normalized levels around 3% over an extended period of time. And you have Fed policy that's, sort of up around that sort of 3% level. So it will take time to get there. And that's, I would agree with what we just heard, is that, sort of the expectation for rate cuts in the second half of next year kind of seem a little less likely than what the market's pricing in. But expecting, sort of Fed funds to kind of collapse seems kind of unlikely at this point, and that you're likely to see kind of persistent inflation and a Fed funds rate that's kind of hovering in that 3 to 3.5% for an extended period of time.
Emily, if we go back to an old normal, in George's words, an old normal, where would you suppose the leadership in this equity market comes from?
Yeah, I think if you see, rates elevated here, that would, speak to some of the leadership that we've seen year to date. You see value stocks having an advantage here. You look down in market cap, maybe you see an advantage there as well. But our view is actually that, rates start to come down and the Fed does cut in 2023. We have to remember here that it takes 3 or 4 quarters for the actions that the Fed is taking to actually be filtered into the economy. So we don't think that it's been fully reflected in the economic data yet. We don't think that it's fully reflected in, really earnings data as well. So as we watch that play out, where we want to be allocated are areas like quality, which hasn't performed as well as we would have thought this year. So companies with great balance sheets, more durable profitability, ones that can hold up in a decelerating growth backdrop, we expect to see a bid there. We still want to own some value stocks. We want to have some cyclicality, some inflation protection in the portfolio. but I think growth and value can actually peacefully coexist in this environment.
Emily Roden, George Bory sticking with us. Futures this morning down by close to 0.2%. Let's get you some movers. Here's Abby.
John, let's go beneath the surface, that relatively flat surface after the worst 2 days for the S&P 500 in about 2 months, and take a look at what's moving more. First up, Macy's shares are popping on a very solid second quarter off of the pre-market highs. That may have to do with the fact that they cut the full year view, however, on, of course, the familiar story of a bloated inventory, big discounting. It seems as though investors right now are taking the view that's more of a positive. Let's see if that gain holds. Intel off of its highs as well. The broader market probably pulling here. They've agreed to a deal with Brookfield Asset Management to invest up to $30 billion in Arizona chip factories. To the downside, Twitter down 3.6%. This, of course, on the story about a whistleblower lawsuit accusing the company of, quote unquote, lying about bots to Elon Musk, coming away from that share price, the offer price of, I believe, $54.20. Let's keep an eye on that story. Just keeps going. And then finally, Zoom plunging down 12.4%, down 83% from its 2020 peak, John. This, of course, after they cut the full year revenue forecast, having to do with weakness relative to their online business, offset a little bit by the phone and enterprise, but it's clear that those pandemic trends are waning.
Abby, thank you. Coming up, the global energy crisis intensifying.
We are working hard to become independent of this gas supply, and we are doing a lot of investments to make it happen, and we are doing it as fast as ever possible. Never such an infrastructure has been built in Germany in that a short time.
Europe, we have a problem. That conversation up next.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. This week, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg's all-star team is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th on Bloomberg Television and Radio.
Of oil in the end of the year, and we are decreasing the imports, and we are taking a lot of investments to become independent of imports of gas from Russia. So we get our gas from Norway, from the Netherlands, from the western ports of Europe.
That was Chancellor Scholz. Germany looking for alternative energy sources with surging prices crippling economic output. Belgium's Prime Minister warning the next 5 to 10 winters, 5 to 10, will be challenging throughout Europe. Nat gas prices surging across the globe amid mounting concerns over stockpiles. This as US gasoline prices post their longest streak of decline since 2015. We've had 70 straight days of it now. Team coverage begins right now with Jack Facci out of London and AMH here in New York City. Jack, I want to come to you, and I think this is so important. I think we all have a relationship with a barrel of oil that we don't have with gas. When you tell me the price of gas, I don't really know what that means in the same way. Natural gas. Jack, can you tell me just how bad things are in Europe with winter just around the corner?
Well, that's absolutely right, but I can tell you that people here in Europe now really do have a relationship with the price of gas, because we're all looking at our energy bills and beginning to understand quite how dramatically they're going to increase. So here in the UK, for example, the average energy bill, I mean, I can tell you my energy bill for my two-bedroom house costs about £100 a month. Goes up a bit in winter, down a bit in summer. It's now projected to go up to about £400 a month and could even be £500 a month. So that's, you know, one of the key bills that most people pay. We're looking now at really a significant proportion of the population, you know, even the quite well-off middle classes now really struggling to pay their energy bills, and that's being repeated across Europe. Depends a bit on different policies in different places where governments are taking a bigger part of the burden, but we're heading for a winter now where prices are going to be eye-wateringly expensive. You know, you look at power prices across Europe and they're something like 10 times the level that they were before this past year, and not just prices, but actually we're talking about shortages. So you have the Finnish grid today came out and started warning Finns that there's a very real possibility of rolling blackouts this winter because they're simply not going to have enough power to supply domestic customers.
Jack, you said a winter. The Belgian Prime Minister's talking about 5 to 10 of them. Jack, your response to that when you heard that?
I know. I think that's right. Look, I think we need to take things one step at a time. The first issue is going to be to get through this winter. There's a real possibility of supply outages across different countries in Europe, but it's absolutely the case that we've all got used to power prices, gas and power prices in Europe being pretty cheap, largely on the back of cheap Russian gas over the past 10, 15 years. We're not going to have that anymore. It's very unlikely. Whatever happens in the coming winter, whatever happens in the war, it's very hard to see how we're going to continue to have very cheap power prices on the back of large supplies of Russian gas. And so I think we need to get used to the fact that energy is going to be much more expensive.
AMH, we've had 70 days of it now, of gasoline prices coming down. Reason to believe that we can continue this trend?
Well, there is some reason to believe that, given the fact that you have China still in lockdown. At the same time, you're over peak driving season of the summer. But there obviously are concerns because you can have switching in Europe. If they're losing natural gas, they could start switching using oil. And also, at the end of the year, those European sanctions on Russian crude start to kick in. And it's not just barrels of oil. It's the shipping, it's the insurance. So right now, the administration is going to the midterms with some very good wind in their sails in terms of gasoline prices. But I also be slightly cautious because what we heard yesterday in an exclusive interview with Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, said that he thinks there's a disconnect between the physical market of barrels shipping across the sea, as well as the financial markets, the paper markets that we track every day. And the words that he said is that basically they could cut at any time. This is just a month since the president touched down in Jeddah, and now the Saudis are pretty much putting out this idea that they might cut production.
I have to say I was surprised to read that yesterday, but I don't follow it as closely as you two, but that seemed ridiculous to me based on what we were calling for a month or so ago. AMH, Jack, wonderful as always. George, Emily, numbers we just don't usually talk about in Europe going into winter. And PMIs this morning, manufacturing in the Eurozone, 49.7. I think we had a 46 handle on the PMI in the UK. Emily Rowland, just a final word on Europe. How difficult is this going to be for this economy and for this market?
It's so challenging, John, and it's hard to have a conversation on the market implications when your heart just goes out to the folks that are struggling with these extraordinary prices here. And I think what I was watching for this morning in the PMI data is there has been a bright side in Europe as it relates to the services sector, tourism alive and well. I know a lot of us have traveled over to Europe and enjoyed that over the course of the summer. And we actually saw those services PMIs also moving lower this morning, which is a challenge there. So, from an investment standpoint, I do still think that there are opportunities overseas, but we'll want to be careful there given those relative economic growth prospects there.
George, I've got 40 seconds. Final word, sir.
Sure. So slowdown in Europe really reinforces the argument that the bond market should hold up in here, both government bond markets, but also to a certain extent selectively in the credit markets as well. While there's some pressure, there's obviously a lot of pressure on the economics. The value in European credit has actually emerged. It's lagged the U.S., and while there's still a lot of sensitivity to slowdowns in growth, pretty much the fundamentals look what we would call good enough for credit. And so from that perspective, from a bottom-up perspective, there's still good opportunities in European credit.
Hey, George, good to catch up alongside Emily Roden. To the two of you, fantastic, difficult, complex issues for Europe. Coming up, the morning calls and later, JP Morgan's David Leibovitz anticipating EM to lead a synchronized rebound in stocks next year. That conversation coming up.
Of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan's society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
A few minutes away from the opening bell this morning. Good morning. Futures basically unchanged on the S&P 500, slightly softer on the Nasdaq after 2 big days of losses on both the S&P and the Nasdaq 100. That's the price action. Here are your morning calls. First up, BTIG downgrading Zoom to neutral without a price target, expecting profitability to remain under pressure after its quarterly results. Wedbush upgrading Denny's to outperform, citing positive channel checks and optimistic meetings with management. And finally, Macquarie initiating coverage on Baidu with an outperform rating, expecting online advertising to recover in Q1 of next year. Coming up, JP Morgan's David Leibovitz making the case for US equities. From New York City, this is Bloomberg.
is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
At the start of the internet revolution, I kicked up a lot of controversy declaring that the internet had been underhyped. I say the same thing today about the climate revolution.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
24 seconds away from the opening bow this morning. Good morning. 2 days of losses, 2 big days of losses on the S&P, totaling up, amounting up to about 3.5%, call it 3.4, even bigger on the Nasdaq this morning. Futures slightly softer, negative about 1/10% on the S&P 500. On the Nasdaq 100, down a little more than 1/10%. It's your opening bow. Switch to the board and get to the bond market. Yields higher again on a 10-year by 4 basis points to 3.0535%, cutting through the 3% level in the last 24 hours and breaking down through parity on euro dollar, 99.42, and coming very close to a 98 handle earlier this morning too. We're unchanged on that currency pair after showing a bit more weakness a little bit earlier this morning. Crude 92.30, up let's call it $2, positive 2.2% this morning. That's the cross-asset price action. We open lower by about 0.1% on the S&P 500. Let's get you some movers. Here's Katie.
John, let's start with Twitter because there's a lot of drama around this name. You had Twitter's former head of security alleging in a complaint that, quote, there were egregious deficiencies in security protections. You then had Elon Musk's lawyers saying today that they've subpoenaed that whistleblower. That's, of course, after issuing a subpoena for ex-CEO Jack Dorsey yesterday. Shares lower off by 3% or so. Moving on, we've got some earnings to get to. Palo Alto Networks, rather. It's a cybersecurity firm. It reported a beat and raise quarter and a stock split to boot. Shares higher by about 10%. JD.com, too. Revenue growth beat estimates at China's second biggest online retailer, quieting some of those fears about a Chinese slowdown, at least for a day. Chinese internet ADR is broadly higher as a result. And finally, Devon Energy climbing from the bell. That's after U.S. natural gas touched $10 for the first time since about 2008. That's good news early for the energy sector, John.
Devon's up 59% year to date. There's a massive winner. And Katie, thank you. This one's been a loser over the last few years in a big way. Macy's, a loser this morning. If you're looking at the outlook getting cut, the stock up by about 2.5%. This is the quote from the company. Continued deterioration of consumer discretionary spending in some of its categories and the level of inventory within the industry, as well as the risks associated with a more pronounced macro downturn. Have you got enough buzzwords in there? Abigail Doolittle. Hey, Abby.
Hey, John. Well, this is an interesting one because we have such a mixed bag this quarter relative to retail. And on the surface, you would almost think that Macy's would be trading lower after cutting the forecast, as you just mentioned. But the stock is actually higher. It was all over the map in the pre-market, down sharply, then up as much as 5%. Right now, up 2.1%. Not bad for cutting the forecast, but you may have really nailed it earlier, saying that it's been a loser in recent months. The stock is down so much that bad expectations could be priced in. So investors happy with about the fact that they actually beat the second quarter expectations. The full year cut maybe not as much as it could have been. They did cut the range. Now, some of it has to do with that weakness relative to consumers really not spending as much inflation, but it's also that familiar story of surging inventories, discounting to get rid of some of that, and then the delicate balance looking ahead to the holiday, having the right inventories for what people want. Now, relative to retail overall, inflation is really cutting into it because it's pretty interesting, John. If you take a look at retail sales out of 2020 on the rise, but if you take a look at retail sales in yellow relative to inflation, it's actually been declining since March of 2021. So this is a big part of what Macy's is dealing with. But right now, investors with that stock up a little bit seem to think that they're up to the challenge.
Well, that move stick. Abby, thank you. This move this morning, not much of one, unchanged on the S&P 500. Energy advancing by a little more than 2%. Information technology, can you call this a bounce back? Up by more than about 0.1%. Let's call it 0.2% higher this morning. It has been tough for the Nasdaq over the last few days. The bears in charge amid the Fed hike jitters. Katie Lyons, real yields back in charge.
Absolutely, John. Those inflation-adjusted yields are really critical here. Now, of course, we had seen a bit of a rotation back toward tech and growth as yields have come in, but as they've resumed their upward trajectory in recent days, that has led to 2 days before today of 4.5% losses on the Nasdaq 100. Its worst 2 days going back to the depths of mid-June. And of course, on the year so far, we have the 10-year yield up 155 basis points, and higher rates weigh on companies with higher multiples. We know that to be true. And the Nasdaq 100, as a result, down about 21% year to date, even worse for the semiconductors, off by more than 27%. Now, I mentioned that reversal we had been seeing up until recently, where value actually was giving back some of the ground it had gained relative to growth. That is the blue line there, the Russell 3000 value ratio to its growth counterpart. The yellow is the 10-year yield. You can see how those two lines generally seem to track each other. Right now, growth is starting to wane once again. But as you mentioned, John, it really is that real yield that matters here. That is perhaps the truest gauge of borrowing costs, if we can ever find one. Those are up about 40 basis points just on the month of August so far, and that, of course, threatens to undermine equity valuations, more specifically rich equity valuations, and eat into their relative attraction to bonds, John.
Katie, thank you. The brilliant Katie Lyons, and really building on that, Michael O'Rourke of Jones Trading saying the following: despite the risk-off environment, inflation fears are prompting bond selling and pushing yields higher. As such, long-duration growth equities are under pressure. Taylor Riggs, you've seen it all week at the close.
We did. We really saw it yesterday, John, sort of a really decent here sell-off when you're thinking about some of those long duration assets. And like you mentioned, the relationship to yields and real yields, as Katie just pointed out, Kaylee just pointed out, I should say. It's really interesting, though, that we're focused on some of the more speculative parts of the market. When you think about the SPAC index, the IPO index, some of the more unprofitable companies, the meme stock ETFs, John, from peak to yesterday's close, you're off 40 to 50 to even 60%. So you're trying to get a little bit of a rebound today, but it has really been a choppy ride in the last few weeks. Now, we talked a lot about Bed Bath & Beyond. There's some fundamental news when you think about some reports of not being able to pay suppliers, a downgrade on the debt to CCC from S&P Global Ratings, but of course just really wrapped up in the meme stock as well. Some volatility, let's say, within this stock too. But John, it really isn't all that. It really sort of has been sort of a macro global story, right? When you think about peak to trough, where we've been a year ago, it really has been coming down a lot across all of these more high beta plays. So we've talked about the more speculative parts of the market, the memes, these high growth areas, but it really has been sort of this global narrative as well.
Taylor, looking forward to the close a little bit later. Taylor Riggs there breaking it down for you. Allow me to break down the market action right now. Not much price action relative to the big moves we've seen over the previous 2 days. The S&P up by a little more than 1/10%. Talked about where the leadership is coming from energy this morning, up 2.7%. It's been so defensive over the previous few days. It's kind of the opposite this morning, with staples, utilities, and healthcare lagging. Healthcare down by about 1 full percentage point. The consensus view, though, is this one: stocks set for choppiness into year end.
I do think that we're setting up for further volatility in the very short term.
Volatility will continue.
Volatility picks back up.
Continue the inflation, and of course, a lot of basis risks.
General uncertainty about where prices are going.
What happens if oil prices start to rise? What's going to happen in winter?
There is this risk of more hawkish rhetoric from the Fed, from the central banks.
There's a lot of risk that isn't in the market right now.
That's a very challenging near-term mix for risk assets.
We have to set up for some choppiness and volatility through the end of the year.
Joining us now is David Leibovitz at JP Morgan. David, always good to catch up with you, sir. Let's start there. Are you getting more constructive or less so as this year progresses?
So I think that from a next 6 to 12 month perspective, it's reasonable to kind of echo the things that just flew across the screen. We think that volatility is going to persist. I think that the underlying driver of this volatility is going to be the rates market. I mean, you look at the MOVE index, you look at what is happening just in the spot market, and rates have been all over the place. If you can't figure out what the cost of capital is supposed to be, I'm not sure how you're supposed to price any financial asset. But this volatility from more of a 12+ month perspective does create opportunity. And we think that over the next couple of weeks here, we're going to get more clarity from the Fed that could well induce, a continued choppiness into the market. But longer term, we do think things will settle as we get more clarity on the trajectory of the Fed's policy rate, as well as the trajectory of inflation.
Forgive me for being the CIO of Hindsight Capital, but clearly looking back to June, that was the big opportunity to buy tech. You were more constructive on that. We talked about it, David. What about now? After that rally off the June low and the weakness that's kicked back in more recently, what about now?
So, things are obviously looking more attractive today than they did a couple of days ago, but we recognize that rates came in likely prematurely over the past couple of weeks. I think, John, the last time we were on, you very directly asked me whether I was buying into the rally we were seeing in risk, and I believe my answer was no. We thought it was a bear market rally. And so I do think you'll have another entry point. I do think that tech could weaken here before it begins to get stronger. But I think what's most important for investors to recognize is that the direction of travel for the economy right now is towards one of slower growth. And slower growth implies lower rates. Lower rates, as we know, can help support multiples. And so I do think that while the clouds are looking a bit dark today, over the course of the coming weeks and months, they should begin to break over the technology sector in particular.
Is that the old playbook then, David? Is that what we go back to? Have we not broken out permanently into a new regime? And I use that word permanently loosely, of course, but I'm talking about a new market regime with fresh leadership, with different dynamics on the growth side, on the inflation side. Do you think we just go back to the old playbook?
So I do think that we go back to the old playbook. I mean, I recognize that inflation isn't going to dissipate overnight. This is going to be an 18-month journey, which hopefully gets inflation back down to levels that are more palatable to our friends at the Federal Reserve. But I do believe that at some point here, we're going to find ourselves in a world of 2% growth, relatively modest inflation, and that implies low rates. Importantly, the technology sector is very different today, particularly the profitable part of the tech sector, than what we saw in the late 90s and the early 2000s. And I think one of the things that investors need to recognize is that some of these companies can actually be relatively defensive. Yes, we're struggling to figure out, what's the right multiple to put on those earnings today, but those earnings, to an extent, have proven to be all weather over the course of the prior cycle. And so we do expect that while there may be a near-term opportunity in value and sectors and industries with more operating leverage, the direction of travel, again, is towards slower growth, and that should inherently benefit those growthier names.
David, that's the destination. Right now, we still have inflation somewhere between 8 and 9%. That's the story right now. To get it down to 2, what's the GDP price we need to pay up to get inflation down to 2?
So I think what's interesting is if you look back over time, it is very difficult to get the inflation genie back into the bottle without causing some sort of contraction or without having some sort of contraction in the real economy. Now, when we think about what that contraction would look like, I don't think it needs to resemble what we saw in 2020. I don't think it needs to resemble what we saw in 2008. If you actually look at the average decline in real GDP from the early 1950s through the late 1990s, it was 2 to 3 percentage points. And so we think that something, in line with that would, again, help get that inflation genie back into the bottle. And importantly, you're beginning to see signs that the economy is slowing. I think the third quarter is going to be better than what we saw at the beginning of the year, and we recognize that there were some idiosyncratic factors which pushed growth negative in the first half of 22. But the economy is slowing here. There's fiscal drag, there's monetary drag. The consumer is beginning to come under pressure, and so I do see a path where we don't necessarily have the soft landing that the Fed is looking for, but we do experience the slowing in growth and the contraction in GDP that gets inflation back down to more palatable levels.
Slowing much more quickly abroad. We'll talk about that in a moment. David, you're going to be sticking with us. It's good to have you with us. Your equity market basically unchanged on the S&P 500. 12 minutes into this, the Nasdaq positive, not even 0.1%. Coming up, disappointing data feeding global recession fears.
In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the US, but It's going to be a slow growth environment, below trend. The Fed wants below trend.
The latest US data up next.
No one covers the world like Bloomberg.
There's a sense it'll get to 7% in the coming months. Do you see that coming true?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I went back and looked, and very few secretaries of state in the last 100 years, or maybe ever, have really gone back into government. So why did you want to come back into government for any issue when you've got 8 grandchildren, you've got 2 daughters, you've got wonderful family? Why did you want to come back and go through this terrible process we have in Washington of getting things through consensus and getting people to agree to what you want to do?
Because I want those grandchildren to have a future. It's very simple. We're not on a good track right now. The world is not serious enough about reducing our emissions fast enough, David. And the result is that the planet is going to continue to evolve in reaction to what we human beings are doing to it, mostly through fossil fuels. Most of the emissions that are going up nowadays into the atmosphere and are creating this increased level of energy that comes from the ocean, goes into the storms, the floods, the rain. All of it is explainable, and it's all linked to the changes we are creating on the planet. So it's very simple. I wanted to come in because I think we have a real chance now to make something happen, and I think Glasgow was a major step forward in the effort to do that.
I think the U.S. doesn't have quite the same degree of headwinds as both China and Europe. In Europe, you've got the gas issue. There's nothing quite to the same degree that we have in the U.S., but it's going to be a slow growth environment, below trend. The Fed wants below trend.
Well, there's some terrible economic data out of America. With more, here's Abby.
There certainly is, John. We're looking at a big miss here for the S&P 500, the S&P Global U.S. Services PMI, 44.1. That is deeply in contraction. It's below the expectation of 49.8. This is, of course, the preliminary reading for August, and it's down from the prior reading of 47.3. There's no way to slice and dice that and make that look good, especially since many are saying that one reason that we may not be in a recession, services holding up. That is not the case here. The manufacturing PMI also missed at 51.3, and the composite in at 45, now down for a 4th month in a row. This is really pretty brutal data, suggesting, John, that again, we could be heading toward a recession.
With one small caveat, it hasn't exactly lined up with the ISM. So we'll see if that lines up with the much more followed ISM, but that is a big, big miss to the downside, Abby.
It certainly is, and that's an interesting point. So the ISM, the companies measured there, they tend to be larger companies, so it suggests that the larger companies have more resiliency, maybe a better ability to plan for a recessionary type environment. So the smaller to mid-size businesses, they appear to be getting hit, especially in the services sector. But manufacturing not too far above contraction either. But again, the overall S&P Global U.S. Composite PMI, their preliminary reading for the month of August at 45. 50, that is the demarcation between contraction and expansion. The composite overall deeply in contraction.
Not good, not good at all. Abby, thank you. I'll tell you one thing it does line up with, the data out of Europe that we got this morning. We had a 49 handle on manufacturing on the PMI in the Eurozone. I think the UK was something like 46. The S&P global economist Andrew Hager saying the following: the numbers, quote, point to an economy in contraction during the third quarter. Declining output is now being seen across a range of sectors as economic weakness becomes more broad-based in nature. Good friend of mine, good friend of ours, Guy Johnson, joined us out of London. Guy, that data this morning on both sides of the Atlantic, not great, is it?
No, it's not great. Actually, I thought we were going to have the worst story to tell here, John, but just looking at that services data on the numbers out of the States does make me wonder about that. Yes, the data out of Europe are really, really bad right now. If the PMI data is about momentum, Europe really doesn't have any. The headline number has come down pretty sharply, 49.2. This is the headline comp number from 49.9 in July. Manufacturing is bearing the brunt. That's probably the difference between the States and what we're watching over here in Europe. But actually, I think the second derivative, if you look at what's happening with services, John, the numbers are not good there either, and we're slowing down rapidly. Major economies are suffering. Germany, we all know, is kind of on point on this one, but France is now slowing very, very rapidly as well. And the ECB is expected to tighten into this, and that is the big difference between previous cycles and this one. The ECB is expected to deliver 50 basis points in terms of hikes in September. The question is, where do you go from there? There is some silver lining to be found here, John, and that is that some of the inflation components within these data are starting to ameliorate a little bit, but it's only marginal at this point.
Hey, Guy, I'm looking forward to your coverage in about 10 minutes as Guy leads you towards the European close. Guy, thank you. Looking at the move at the front end, bit delayed, but yields lower by 3 basis points now at the front end, the 2-year about 328. Equities picking up just a little bit on the NASDAQ off the back of some of that, I guess up by 0.25%. David, you're back with us. You heard what my good friend Guy Johnson had to say about the situation. We're going to tighten into some of this weakness. We'll start with the United States, then we'll go to Europe. In the US, David, what do you make of that economic data we've got this morning? Because I can tell you a different story from one data point to the next.
So obviously a big miss in the United States. And frankly, we've been somewhat surprised with the resilience of the data as some of the higher frequency indicators we've been looking at, things like jobless claims, have been rolling over. You know, it looks to us that this was more a question of when. As opposed to a question of if. And so I guess to an extent, this kind of validates what we've been expecting to happen, you know, a bigger move to the downside than anybody expected. But, you know, the Fed has done a lot here, and some of the tailwinds that were present over the past couple of years are very much beginning to fade. And so, you know, as we were talking about before the break, we're kind of moving back into this environment that is very similar, I think, to what we saw in the aftermath of the financial crisis. And that in and of itself, you know, over the course of the next 12 to 18 months, hopefully begins to address the inflation issue in a more significant way.
We've got this weakness in Europe we need to factor in as well, David. Ed Yardeni, much followed Ed Yardeni of Yardeni Research, said the following: a severe recession in Europe might not cause a recession in the US, but it certainly would depress the earnings of many US corporations. He went on to say it would strengthen the US dollar further, which would also depress earnings of US companies with sales in Europe. David, are you factoring that into the parts of the market that you like and the parts of the market you want to avoid?
We are. We think that the dollar issue is one that is likely to continue to plague companies for the foreseeable future. I struggle to see how in the environment that we're in, we see a material weakening in the dollar. To me, that's very much a development for the other side of any slowdown, both in the United States, but more broadly around the world. And the situation in Europe is not good. You know, the probability of recession there over the next 12 months, we believe, is north of 50%. As many have said on this show, the gas issue is a significant issue. The energy issue is going to weigh, particularly as temperatures begin to fall. We're in a very different position here in the United States where we're effectively energy independent. And while, at the end of the day, it tends to be the United States catching a cold that gets the rest of the world sick, I do think that, unfortunately, we are looking at slower growth globally over the course of the coming months.
David, just quickly, a final question from me, and I've asked this in different ways throughout this morning. Do you think we fully understand what is about to happen in Europe later this winter based on incoming information? And I really, really mean that. Do you think we fully understand it? Because when I hear forecasts like 18% CPI in the UK, and people go, wow, that sounds like a big number, do we actually understand what that could mean to the UK economy, to the Eurozone, etc.?
I don't think that people really grasp the severity of this issue. I think at the end of the day, we've been very lucky over the better part of the past 5 to 7 years, really ever since the fracking revolution back in 2015, we've been very fortunate to have low energy prices, effectively across the board. And that is a dynamic that has very much shifted here over the course of 2022 thus far. I think not only is this going to be a headwind for the consumer, and there's a whole social aspect to this that we need to be cognizant of as well, this potentially could be a headwind to industry, particularly in the Eurozone. And I do think that while there is a long-term solution in going green, getting there overnight is very difficult to do. And so I do think we need to buckle our seatbelts because it's going to be a tumultuous couple of months, particularly for our friends on the other side of the Atlantic.
Big time. David, thank you. David Leibovitz there of JP Morgan Asset Management. Thank you, sir. So what have we got? We've got data with a massive downside surprise in the US. Yields down at the front end, and we let out a ton of oxygen out of that strong dollar trade. The dollar index rolling over negative about 0.5% right now. Up next on the program, I'll get you to the trading diary. That's next. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Let's call it 26 minutes in. Equities rallying in the face of some pretty ugly data out of America. Equities up 0.25% on the S&P as yields pull in at the front end, just a pick up on the Nasdaq by about 0.5%. We'll see if this sticks. That's the price action. Here's your trading diary. New home sales at the top of the hour. Minneapolis Fed President Neil Kashkari speaking at 7 p.m. Eastern Time. US GDP and another round of jobless claims on Thursday, plus the Fed's annual Jackson Hole get-together. We'll hear from Chairman Powell on Friday, and you'll get a ton of data too. We get you, Mitch, PCE deflator, and personal income and spending data too. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What is your base case for Italy in terms of what happens politically and then what the economic fallout is?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be a ploy by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone, In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and who. Although outlawed 7 decades ago, castes remain a significant factor in ties and cultural traditions government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as